Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Conan, along with Brianna Valesky, and I have Bridget Weishaar on the line. She's an equity analyst for Morningstar, focusing on the retail sector. Bridget, how was the three-day weekend?
It was wonderful. How was yours, Joel?
It was good, a little bit chilly, but we're back in the saddle here. Well, let's talk a little bit about your background, your education, and how you ended up becoming an analyst for Morningstar in the retail sector.
Sure. So I got my MBA at Wharton in finance, and pretty much ever since then, I've been in equity research. I worked 2 summers at Bear Stearns covering the apparel sector, and then spent 5 years at JP Morgan on the internet equity research team. And now I'm at Morningstar back covering apparel again, both the retailing and the manufacturing side of it.
So is this kind of what you ended up in, or is it something that you've already an interest in?
I was a career switcher. I was in education. I worked as a professor, so I had experience doing research and enjoyed that. So for me, when I made the leap to the business side of things, I think it made the most sense in combining that past skill set with a new job in finance.
Okay, so I always like when I get analysts on the line. I think it's an extremely difficult job, and I don't want you to reveal your secret sauce. But when you're looking at companies, doing your ratings, coming up with your estimates, just kind of walk us through the process.
Sure. So at Morningstar, we tend to be focused on long-term performance over short-term quarterly calls. So my favorite calls, the first thing I look for is some sort of disruptive force that is going to change the trajectory of either the revenue growth at a company or the margins. So that's kind of where I begin with. Then I look at the companies that would be affected by this force, and I look to see if they have an economic moat or some sort of competitive advantage that would enable them to take better advantage of this disruptive force than other people in the space. Next, I move down and I look to see if they have the capital on their balance sheet to make the necessary investments and also the leadership in place that can execute their strategy. And then the last place I look is at the valuation. So I want to see if this is something that the market is aware of and has fully priced into the stock, or if this is something that I think I have an edge on and it's a good point to buy into the stock.
And this kind of all figures into your discounted cash flow analysis then.
Exactly. So that's the valuation, and there's two ways to do the valuation: either multiple analysis or discounted cash flow. Because we tend to be a long-term investment shop, we like the discounted cash flow because it really looks out. If you have a long-term story that's going to take a while to play out, the DCF analysis is going to price that in much better than just looking at a multiple on 1 year's or 2 years growth.
And how about the charts? Are you a technician there, getting out your charts and drawing your lines and making your projections and looking at your double tops and double bottoms and things like that?
No, we're not at all. Again, we veer more towards the long. So when it comes to doing research with us, we're much more likely to talk to the company in my space, to do store visits, to visit manufacturing facilities, talk to people there, and just really learn the industry very, very well. And again, look more for the long-term
Okay.
thesis than calling it a specific point.
Okay, so you like to look at the off-price retailers as well as some of the upper ends. Let's start out with some of the off-price retailers here. Do you have a favorite pick in this sector?
Sure. So, I think one of the biggest trends that we're seeing and one of the few growth spaces in apparel right now is the off-price sector. Consumers are very, very focused on getting a value, and off-price retailers are set up structurally that they can offer the promotions that consumers are demanding without having a hit on their margins. So, I think my favorite in that space is TJ Maxx. They've got a very interesting top-line story that includes growth both through new stores and through same-store sales. So on the new storefront, we think that they can grow from about 3,000 stores now to about 5,000 stores internationally in the current markets, plus they might get another 1,000 stores by penetrating new international markets. And on the comparable sales, there are a lot of customers that still have not ventured into their stores. So same-store sales are still growing at a very healthy clip of like 2 to 3%. So that would be one of my favorites in that space.
Okay, and then I think when we talked last week, you had mentioned Gap stores, and
Yes,
yeah,
yes.
what's your give
Now,
us your outlook on Gap stores, GPS?
so Gap is interesting because it's playing off of two trends. First, a second growth category in apparel is the athleisure movement, which is basically wearing athletic apparel in more everyday leisure activities. So that's a growing market. And with the Athleta brand, Gap has exposure to it. It's in the very early stages of growth. It's a higher margin business. So that's one reason we like that on the sum of parts analysis. That brand can add a lot to the value of the stock. The second is that they are shifting towards a pull-based supply chain. And what that means is that they're going to have the capability, hopefully, of better matching their inventory levels to demand, which would mean much less discounting, which is what's killing them right now. So if they can drive better full-price sell-through and close the gap between where they are and where fast fashion retailers that already have this pull-based supply chain in place, they can get at least 300 basis points of upside in their operating margins. So, I think on a valuation basis, it's trading well below our fair value estimate of $48, and we like the long-term story on multiple levels.
I know. My wife loves that Athleta brand and real sharp stuff, and I know she likes that quite a bit. VFC Corp, does that fall into your off-price category as well?
Nope, VF Corp would actually fall more into a direct-to-consumer and international growth story, as well as the fact that because it's so large, it has a brand portfolio of over 30 brands. They have a real competitive advantage in their scale, which leads to better margins. So VF is interesting because they are growing their outdoor and action sports, which would be the Timberland brand, the North Face brand, the Vans brand. That's growing at a very healthy pace in the double digits. They also tend to make acquisitions, and I wouldn't be surprised to see another one in outdoor and action sports sometime in the near future. And once they bring in these acquisitions, like they just did with Timberland, as they switch it over to their supply chain and their manufacturing system, they get an enormous amount of synergies and multiple expansions. So VF is really, I just think, one of the best-in-class operators, and we like its brand portfolio and its acquisition strategy.
Okay, out of the chat from SF Bright TG, does Bridget like Philip Van Heusen at these levels?
Yes,
PVH.
now that's an interesting question. That one has really traded down,
Ooh.
and it's done so on two things. One, the foreign exchange rate. They are very exposed. If you look at their two core brands, which is Calvin Klein and Tommy Hilfiger, you're looking at almost a 50% exposure to international markets. So it's traded down on that as the market has adjusted for the translation impact. The second thing is Ralph Lauren reported very weak earnings, and people read through from that these two brands roughly have the same exposure to the same market, so their earnings might be weak. I think at these levels, though, a lot of that potential weakness is priced into the stock, and I think, in the near term, there's going to be an awful lot of volatility given their exposure to Europe and the macroeconomic things going on there, plus the FX, right? But if you are a long-term investor, I think this is a very strong price point to enter into the stock on.
Okay, let's talk about the dollar, and that's definitely has showed up in earnings not only for some of your retailers, but some of your Procter and Gamble, some of these companies that do a lot of business overseas, and this is really the first quarter that we've seen that the dollar taking this kind of effect, negative effect on earnings. Do you think this is just a one-off here, or do you think some of these companies are going to have to deal with the headwinds from the stronger dollar in 2015?
I think it's probably going to play out through 2015. I mean, this is a hard call to make, knowing what's going to happen with the markets, but I think it's going to be a headwind for the year. So stocks that have a very large exposure to Europe, I think that their earnings are going to be much weaker. But I would also comment that you've got two things going on. There's two impacts from FX: translation and transaction impact. Translation is basically converting your revenue over to the U.S. dollar, and that's where they're all getting slammed. So the revenue growth looks much slower than it actually is on a constant currency basis. The transaction impact, though, plays more into the profitability, and it includes the cost factor of the FX impact. Most companies hedge that, and so I think a lot of the companies, at least in my coverage universe, are hedged on a transaction basis for 2015. I think that will help mute the impact somewhat.
Okay, let's move into some of these higher end retailers, and I just don't understand these things. And the one I don't understand the most is Lululemon. I mean, look at this stock at the beginning of the year. We'll pull up the chart here. Beginning of 2015, this thing was at 54. At the end of 2014, it was at 44. Now the thing, not quite back up at all-time highs here, but just one heck of a rally. Bit of consolidation here. I mean, did they really start selling that many more yoga pants? I mean, I just how do you explain such a rise in a stock like this?
So they were unique because this time it wasn't so much a problem with the market. I think a lot in apparel, what you have as headwinds is a lot of people are spending less money, so it's very promotional, and also you have less people going into stores and into shopping malls, so lower traffic levels, more e-commerce. These are the things that most of the companies in my coverage are fighting. With Lulu, it was a very different story. Lulu, again, is exposed to that athleisure market, which is a high growth market. And so they were a little bit more shielded from the impact of those other drivers. Their problems were self-created. They had product problems with the see-through yoga pants and the pilling yoga pants. They had problems with their leadership team, with their CEO making unflattering comments about heavy shoppers shouldn't be wearing their yoga pants. They had a lot of turnover going on within their management team. So these were kind of the headwinds that they were fighting, and they were of their own making. And that's what drove that stock down. Now, why has it rebounded? They have a new management team in place. The new CEO has done a very nice job of really digging in and improving the supply chain and hiring some smart people to assist them on that. You have the founder kind of taking a back seat from the limelight and having much smaller part in the company, including selling off some of his share ownership. And you've started to see traction again in the stores with that core consumer coming back in and making purchases. So they're not completely out of the woods yet. This year, I think you're still going to see a little bit more margin and pressure as they make the necessary investments in the supply chain to completely turn this around. Also, as they shift product to a more seasonal fashion forward product, it's going to have a lower margin in terms of mix. But they've got that customer back, and that's the hardest thing, I think, for a retailer is to get back that core customer, and they've shown that they do that. So I'm not surprised that it's seen such a pickup. I think that this year might be another very good year for them. They still got relatively easy comps, and they're still in a quickly growing space.
Bridget, this is Brianna. I'd love to ask you about some of the teen retailers, where some of them, like Aeropostale and Abercrombie and Fitch, seem to be much more popular, 5, 6, 7 years ago. Urban Outfitters has gained a little more traction recently. What's your outlook on the teen retailers?
We actually dropped coverage of the teen retailers. At Morningstar, we tend to cover companies that we believe have an economic moat. And the moat source for most of the names in my coverage, a lot of it comes from the strength of a brand. And in our opinion, those teen retailers didn't have enough brand strength to dig an economic moat or have any kind of competitive advantage. Urban Outfitters, we do cover. That one, we don't think they have a moat yet, but we have a positive moat trend rating on it, saying that we think the brand's portfolio is getting strong enough to have significant pricing power. In terms of what the younger consumer is looking for, that is probably the hardest market right now. A lot of share has shifted over to restaurants. They spend more money on food and entertainment, to electronics, and it's shifted away from apparel. It's just less important to them. Also, there's been a fundamental shift in what they look for in apparel. They no longer want a brand splashed all over their clothing with the logo in big print. They don't want to look like everybody else, whereas back in the heyday of Abercrombie and Fitch, everybody wanted to be seen in Abercrombie and Fitch. Urban does a much better job of catering to that individuality that millennials are craving. They bring in lots of unique clothing. Very little of it has logos printed all over it. If you look at Anthropologie, you look at Urban Outfitters, the store is very niche-y. It's going to be attractive only to a certain subset of consumer. It's not trying to be everything to everyone. It's not mainstream. That brand has just seen tremendous pricing power and sell-through. So it really doesn't surprise me that they're outperforming the traditional teen retailers at this point.
Going back to your analysis of retail stocks, and obviously earnings and the dollar, those things affect the price, but how much emphasis do you put on comparable same-store sales?
A lot of emphasis. So when I look into a company to just kind of judge how it's doing performance-wise, on the top line, the number one thing I look for is the same-store sales or comparable sales. They give an indication of the volume, so is the company gaining market share or not, and also the pricing power. So are they able to sell through at a good price, or are they discounting a lot? So that's one of the first metrics I look at. The second is new store growth. The quickest way to die in retail is to overbuild your store base. So, are they growing faster than they should be? Does it make sense that they're growing at the clip that they are? What are store productivity levels doing? And the third thing I look for on the top line is inventory turns, and that's really the second quickest way that a retailer is going to suffer. If you have too much inventory, you are going to have to discount it to get through it. It also means that you're not going to be able to get new inventory into your stores because the old stuff is still sitting there. So those are really the three metrics I look at to judge top line growth.
Okay, and just any final words for advice for investors looking into the retail sector? I know it's very volatile, and earnings and other news is affected. Is there any last words of advice you have for investors?
I think it is an exciting space because of that volatility. For a while, I think a lot of the upside was priced into these stocks. I think that the volatility you're seeing in the market is giving you some real opportunities to buy quality companies. So from a Morningstar standpoint, what I would do is look for a company that you think has a strong band or a competitive advantage in terms of costs of goods sold, and follow it, wait for a good entry point, and try to take advantage of some of the trends: off-price, athleisure, direct-to-consumer.
Spread it around a little bit. Bridget Weishaar, equity analyst for Morningstar, giving us a great outlook here on the tricky retail sector. Bridget, thanks for coming on, and we certainly hope to have you back on again.
Great. Thanks for having me.